Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Welcome into Life Planning 101. My name is Angela Robinson with Smart Money Group and Kennedy Financial Services out of the big metropolis of Eastland, Texas. And we are honored today. We have an incredible guest, been on the show with us before, but I don't think there's better timing than now, except for maybe earlier than now because of the topic that we're going to be talking about. It's things that needed to be done yesterday. And what we've got today, we're going to be talking about your estate plan. We're going to be talking about estate taxes. And our very special guest is Kyle Post out of Stephenville, Texas. He is a tax attorney. I actually just got through telling him that he's a humble tax attorney. We should add that to his pedigree there, so to speak. But no, he's wonderful to work with because, you work with so many professionals over time that they just confuse the heck out of you. And you leave feeling, I don't know if I was helped or hurt in that situation. You have a stack of documents that you really don't know what you have. And you say, okay, well, I've got an estate plan. It must be right. And we know in our business that unfortunately, a lot of times that's just simply not the case. And what I found about working with Kyle Post over the years is not only is he extremely intelligent and informed in all things estate planning and estate tax, but he does show up to want to help the client figure out what they really, really want and make sure that they understand what they're really, really getting. And so just appreciate you, Kyle, all you do to serve our families that you do. And thanks for being on the show today.
Well, thank you, Angela. I'm not sure how to respond to all of those compliments, but I sure appreciate them. And I enjoy working with you and your team. It's been great to have this relationship that we've had over these last few years.
Absolutely. We say we're not usually, and you know this, we're not married to any other professional, but I'm feeling like we're closer and closer to married to Kyle Post and all that he does just because he serves our clients so well and like-mindedness and culture. But just appreciate you coming on the show today. I know right before we jumped on, you said that you had kind of a scenario to paint. And we've had past shows, we've talked about that we have this big old sunset coming tax-wise where all of the Trump tax plan, so to speak, is set to expire. And I know you mentioned you've got kind of okay, if we've got this situation and we do nothing, this is what it looks like today in 2024. And if the sunset occurs, so in other words, they don't get something passed to extend tax reform, this is what I'm up against from an estate perspective. So I thought it'd be great if you just open up and share that with us and we can go from there.
Sure, that sounds great. As you mentioned, we've got a sunset looming at the end of 2025 with the estate tax. And so a simple example that is simplified, but I think illustrates the importance of potentially doing some planning before then. If we take, for example, a single individual who has a $12 million estate, and if they were to do nothing prior to the sunset of the estate tax laws and they died after January 1st, 2026, that $12 million estate, based on what we anticipate the laws being at that time, that would be $5 million of that estate would be subject to a 40% tax. So that's $2 million in tax that their estate would incur without doing any planning prior to the sunset. If that same individual, on the other hand, did some planning prior to 2026 and made a $10 million gift, if they died after 2026, then only $2 million of their estate would be subject to that 40% tax, which would be an $800,000 tax bill rather than a $2 million tax bill. So just in a very simple example, there's a $1.2 million tax difference by engaging in some planning prior to 2026 versus not doing anything prior to that sunset.
Right. And, I find that a lot of people say, well, I don't have $12 million of cash. And I want to make point to every farmer, rancher, business owner out there. Do you know what you have? Do you know what it's worth? Because, and I think especially in those cases, when you agree, Kyle, if you have illiquidity of 12 million, do they still owe the 2 million of tax?
They do, no matter what assets you have. As a general rule, the value of those assets is taxed. So whether it's real estate, whether it's a closely held family business, whatever it is, if it's above that exemption amount in value, there's going to be a tax bill due. And if you don't have the liquidity to pay the tax, you're going to have to find that liquidity somewhere. So it's, in those cases, maybe even more important that they do some planning before 2026 to eliminate or reduce that tax bill that could come up.
Absolutely. So you could either, options are die now, just don't die until they change the tax code again, which may be how long? Who knows, right? Or do something about it. That's what we got, right? Yeah.
And I don't like a couple of those options, I'll say.
That's right. Well, on previous shows, we've been talking about this, that I don't think people realize how hard it is to get tax reform extended or better or anything, right? So what does it take? It takes the House, Senate, and then the president signing that bill to get anything done?
Exactly. And we had, if we think back to the current law that we have now, which is based on the Tax Cuts and Jobs Act that was passed in 2017, in my mind, we kind of had the perfect storm at that time to do a lot more than what ended up being done with estate taxes. There was talk at the time of even repealing the estate tax based on the makeup of Congress and the Senate and the president at the time. And so we got what we got, which was a temporary fix, but couldn't get it done then. The chances of getting it done now to improve our estate tax laws are slim. And as written, the laws are already going to change. That's what the sunset is. It's a reduction in the estate tax exemption that's already written into the law. Nobody has to do anything. It happens automatically. And, before the show, we were talking about some of the proposed legislation based on, depending on which administration gets into office and depending on who wins, the proposals aren't going to be favorable to taxpayers. We'll say that.
No, and I think that's a good cliffhanger while we take a short break. And when we come back on Life Planning 101, why don't you just walk through some of this proposed changes and what that could actually mean for the families that we serve? Thank you again, Kyle Post, for being on with us today at Life Planning 101. Stay tuned. You're not going to want to miss it. Welcome back into Life Planning 101. My name is Angela Robinson with Smart Money Group and Kennedy Financial Services, and we are here to bring you very relevant information so you can be empowered to make decisions to help you and your family live life on purpose. And today I'd say it's really more about your family, because when you die, who cares? But your family might if they owe millions of dollars of taxation. So we have Kyle Post, our tax attorney that is our go-to resource at Kennedy Financial Services. And he is here explaining what is going on with this so-called sunset in 2026. In other words, you do nothing before 2026, you could get a big surprise if you were to fall over dead. And even worse is, I think there's some proposals, and just, to put this in perspective, we've seen proposals for years now, and usually those are precursors to something inevitably happening. And there's some proposals on the table, and it doesn't matter what your political views are. You need to be thinking about yourself right now. You need to be thinking about your situation and if you need to be doing any planning. So I'm going to go ahead and let Kyle off the hook, because this is not meant to be a political stanza. It's just meant to be that, unfortunately, it's the way of it. The Democrats actually have some pretty strict proposals that we want to go over, and you need to know how they affect you. So, Kyle, thanks again for being on the show with us. You left us with that nice cliffhanger about these possible legislative changes, things that Vice President Kamala Harris wants to put into place. And I'll let you just take the floor and scare everybody. It is the month of Halloween, so it works out well.
Well, yeah. Well, let me dive in then, just kind of give a little bit of background as to where we are now, so everybody understands how dramatic these changes would be. Under current law, we have a lifetime exemption, so a single person can give away either during their life or at death, or some combination of the two. Currently $13.61 million. At the sunset that we've been discussing, that's going to cut that number in half, roughly about $7 million will be that exemption. But the proposals that you mentioned, Angela, are even more drastic than that. Some of the proposals on the table would reduce that lifetime exemption amount to $3.5 million. So, simple example, a person doesn't make any gifts during their lifetime and they die with a $4 million estate, they would owe estate tax on $500,000. So that exemption is what the amount that's not subject to estate tax. $3.5 million is not that much in today's world with the value of real estate and houses and everything. So as you can imagine,
that's a house and an IRA and a life insurance policy.
Yeah, I mean that touches a lot more people than the $13 million exemption that we currently have for sure. In addition to that exemption change, the estate tax rate is actually going to go up significantly as well. We mentioned previously that the current estate tax rate is 40%. Under this proposal, the lowest rate would be 55%. And then some estates would be taxed at 60%. Some would be taxed at 65%.
Wow.
And if you are a billionaire, there's an additional 10% tax. So any amount that is taxable is going to be taxed at a lot higher rate under these proposals as well.
This reminds me of that, if they wanted to simplify the tax bill, they could just say, what did you make? What did you spend? Now send in the balance. I think that's where we're headed.
That does seem that way. These are drastic changes. I've been doing this since 2008, and these are, and the law, unfortunately, has changed pretty much every year since I've been practicing, and makes it hard for individuals and families to plan when it's a moving target. But these are similar to proposals and the laws that existed back in 2008 and 2009 as far as what the exemption levels are. So major changes, and there's some others that are out there as well that I'll just mention one quickly. Technical tax term, a grantor trust, which is a type of trust that is used very frequently in estate tax planning. For example, many life insurance trusts are these grantor trusts. And these are a tool that we use regularly in estate tax planning. This proposed legislation would essentially eliminate the use of grantor trusts in estate tax planning because it would cause that trust to be included in your estate. Whereas under current law, you can create a grantor trust and the assets are not included in your estate. So that in my mind is also a huge change to the existing laws that we have now and the strategies that we use for estate tax reduction.
Yeah, and just to put that in, perspective, I think this is really important. So, we use life insurance trusts for a lot of reasons, and that grantor status, correct me if I'm wrong, Kyle, this is just where it taxes it back to the grantor, to the trust, correct?
Exactly.
Yeah, yep. So you don't have it.
The trust is basically ignored for income tax purposes so that there's not a tax at the trust level. It's taxed back to the individual who created the trust.
Which is friendly, in other words. Yeah. So, we use this a lot, and not just for estate tax. I mean, a lot of times, we'll set up a trust for a multi-generational purpose. Parents are scared that the kids are going to spend everything and they want to make sure the grandkids get it. Well, we have no idea. And I guess it is for estate taxes. We have no idea what that estate tax picture is going to be. So we're just ensuring that things get to where they needed to be done. So I think it's a very, very powerful thing. And that brings me to a question. What about if they were to set that up now, and then we're sitting here in 2027 and that law has changed, can they still use that trust?
Good question. And as proposed right now, the new legislation would generally apply prospectively only going forward. So after it's enacted, it wouldn't affect existing plans that are in place already. So that's another reason to think about engaging in some tax planning and trust planning prior to these potential changes going into place.
Wow. Yep. Well, if this isn't like getting you a little bit in the gut or making you squirmy, I don't know what else will. Maybe you need to go to a haunted house this month. But when we come back, we're going to hear more from Kyle Post, and we're just going to talk about some other possible changes that are out there. And I think most importantly, what you need to be doing about this information, because like I said, it depends. Do you love your family? If you love your family, you want to make sure they aren't taxed to death. What do you need to be doing right now to protect that? So join us right back here on Life Planning 101. You're not going to want to miss it. Welcome back into Life Planning 101. Joined with us today is Kyle Post, our tax attorney that is KFS's go-to tax attorney. And just thank you for your time. I know you're busy right now. As I'm sitting here listening to the show, I'm like, oh, I can think of all the things that we're working on. So really appreciate you doing this just to educate people, inform people, empower them to make good decisions. And I think that's really where we're at with the show is, okay, you got this looming estate tax, and it's more probable than not that things are changing and not for your benefit. What do you need to be doing right now, 2024? What can wait to 2025? What can't? And I know, Kyle, I've heard you talk to our clients about this, so it's good. It's good to hear. And I think everybody needs to know.
Yeah, no, I mean, it's definitely, we have a window still, which is good. We have a window of planning opportunity, at least until the end of 2024. And as currently enacted, it will have through 2025 as well. So really the key to this for many people will be engaging in some sort of gifting and trust planning. As the example that I started off the show with illustrates, we have a window where we have call it $14 million of exemption, and that number is guaranteed to go down and be cut in half at the end of 2025, and it may be cut even more if some of these proposed changes occur. So what we're trying to do is take advantage of that large or higher exemption amount that we have. And the way to do that is to make large gifts and put assets into trust, either for a spouse or for your kids. I like using trust because they protect assets from creditors and they protect them from future estate taxes as well. If you were to make a gift directly to an individual, you might have solved your estate tax problem, but you likely created an estate tax problem for them. So putting an asset into a trust is a good way to avoid that.
Yeah, I want to bring a point to that, Kyle, because you and I have been working on something that's a great consideration. People try to do this last minute planning, and then it's an outright gift. Well, all you've done is shift estate tax problems to that next generation. And so in essence, you may have made things worse because if these things go into effect and estate taxes are cut in half and inflation has been what it's been, what's that really mean? That's just increasing the overall taxation. So I think it's really important that buyer beware, I guess. Don't just go to doing or don't go to implementing without some good advice behind that.
Exactly. I've seen it, unfortunately, a few too many times where people didn't get the right advice and they just made large gifts, and then now you've got a situation where the kids are facing this estate tax situation and they're going to have lower exemptions, and these assets are going to grow a lot over their lifetimes and over the next 40 years, and then they're going to have a huge estate tax problem down the road. So definitely something to keep in mind as you think about some planning options and what you want to do. And then one other thing I think will be important, let me go back first. There's a variety of different trust structures that you could use to make these gifts, depending on who you want the beneficiaries to be. Obviously, people are concerned about giving away large sums of money because they're worried about how that's going to affect their lives and their standard of living. And so we take that into consideration, and we may not want to make a $10 million gift directly to the kids or grandkids or in a trust for them. And so maybe we make a gift to a spouse or some other structure that way. So there's a variety of different trusts you could use, but going forward also, I think taking advantage of the annual exclusion that we have for gifts, which right now is $18,000 a year that you can give to as many individuals as you want, and it doesn't count against you for this lifetime exemption. It's not subject to tax. So if we have an extreme reduction in the estate tax exemption amount, then taking advantage of those annual exclusion gifts will become more important to try to remove items from our estates, but not have to pay a current gift tax on those gifts.
Absolutely. Absolutely. And I think it's just so important for people to know that if you try to push this off for a year, good luck getting Kyle good luck getting anybody to get anything done. I mean, this, I was asked by a client just recently, how soon do we need to make this decision? I said, well, we're not ones to usually put pressure. We want to make sure people are making very good, educated decisions and sleep on it before they do that. But really, I mean, 3 months ago probably would have been ideal, and even more so 2 years ago would have been more ideal. So the sooner the better. And I think that's really, really key here. Kyle, thank you so much for coming on today. Life Planning 101 information you provide is invaluable. And like I said, we just truly appreciate when we get to work with you for the families that we serve. We know they're going to be taken care of. So thank you for always being who you are and your culture behind it. So
well, thank you, Angela. I enjoyed being on, and I enjoy working with your team. As I said, I'm happy to be part of the service that we provide to your clients. So thank you again.
Absolutely. And if you have more questions for Kyle Post, make sure you subscribe to our weekly Life Lessons newsletter. We're going to have his contact information on there, highlight a biography of him this week. And you can sign up for that at www.kennedy-financial.com. And it's just good to sign up for that newsletter anyway. New, relevant, always, nothing canned, nothing that we just pull down and throw on there. We put on stuff that we know is relevant for the clients that we serve. So we appreciate you. God bless you. Have a great week. And be sure to join us next week right here on Life Planning 101, where we help people live life on purpose.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Don't forget to learn how our sister company can assist you with all of your tax and consulting needs. You can find out more at briscoeandassociates.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member of FINRA SIPC. Investment advisory services offered through Smart Money Group, LLC. Kennedy Financial Services and Smart Money Group, LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.